landscape of finance, one thing remains constant: the need for a reliable partner. At Yes Securities, we are not just wealth managers, we are architects of financial success. Our experience over the last decade has been a steady and remarkable journey leading to growth in the labyrinth of financial opportunities. We don't just find a way, we create it. We don't build walls, we build bridges that connect ambitions to achievements. Innovation is not just a word for us, it's the heartbeat of every decision we make. Your success isn't just a goal, it's our mission, our commitment to your financial journey. We provide world class solutions across multiple products, catering to institutions, high net individuals, and retail investors across sectors. Because your success is our business. Yes, Securities, empowering tomorrow.
Hello everyone. Welcome to our new session of Yes FinPulse, a webinar series dedicated to exploring the technical aspects and broader discussion in finance. Our mission at Yes Securities is to make finance accessible to everyone, regardless of their background or experience. Over the past decade, we have evolved from transactional broker to a trusted advisor for both retail and institutional clients. Before we dive into today's topic, let's make a quick moment to reflect on our last session. On 29th May, we had privilege of hosting the session on decoding investment in a high growth environment featuring Mr. Ravindra Bhandari. Hope you all found that session as enlightening as I did. Now let's get down to business. Our today's topic is navigating fixed income securities. It is my pleasure to introduce our esteemed speaker for today, Mr. Sachin Chardal. Sachin manages the multi-asset desk at Yes Securities with keen focus on fixed income investments. With approximately 12 years of extensive experience in product and investment management, he has been a valuable asset to various companies throughout his career. Today, Sachin will share his deep insights and knowledge on the basics of fixed income, a critical area of finance. And guess what? If you miss any of our sessions or want to revisit the valuable insights shared, don't worry. We'll be uploading the entire series on YouTube under playlist named Yes FinPulse so you can catch up at your convenience. Remember, this isn't one way street. We want to hear from you. After Sachin's presentation, don't hesitate to ask questions and share your doubts in the comment section. Also, we have polls and quizzes coming throughout the webinar, so be alert. Over to you, Sachin.
Hi all, welcome back. The idea of this entire session is to help you understand the nitty-gritties of fixed income securities. In our last presentation that I did, I'm not sure how many people have rejoined. So what I'd like to do is give you a quick recap of what we discussed in our last session, and then maybe I'll give you a brief of what this entire session will be. Uh, so what I've kind of decided to do is, break this entire asset class in a way that everyone can easily understand in basic few parameters. One is how would one, want to assess this particular asset class? How would one align their financial goals and using fixed income as an asset class to help those financial goals, and see them completed? And finally, achieve those financial goals with the help of this particular asset class. In this particular session, we will only look into the assessment part. What are the key parameters that one should look at as an investor when you want to choose a fixed income as an asset class to be sort of investing? And then in upcoming sessions we'll look into the sort of calculations that one need to understand while understanding, if one is paying a fair price for the security that you're buying. And then finally, how to achieve, basically what I want to cover in that is give you a brief of the entire fixed income market in India, where it is headed, where was it, what sort of opportunities that are available for investors in this particular asset class. uh, this session will only and only kind of be concentrated on assessment of these particular securities. So as I said, just to give you a recap of what we did last, in my last session, what we did was we covered basics of fixed income. So basics of fixed income is nothing but what are the components that kind of make fixed income as an asset class. These components are basically coupon, face value, maturity, the sort of rating, and then yield and price. Uh, Anything and everything that constitutes as fixed income investment, has these parameters more or less kind of imbibed in them, and a few changes here and there will differ that particular security from one security to the other security. So coupon is nothing but the interest rate that you would be getting paid for the money that you lend to an institution. Face value is the sort of initial fixing price which will never change, and the coupon is paid basis the face value. Then maturity is basically the tenure of the instrument. Rating is basically the quality of the particular instrument, and yield and price is nothing but the current. Basically, it reflects or represent the current value or the value of that particular security. So before I go into the details of how to assess, quickly I want to kind of throw up one question just to make sure you guys are in line with what we had discussed last. So there, the question I think is live on your system. Basically, the question goes like coupon of a bond stays constant unless otherwise stated, whereas yield of the bond keeps changing as per the market environment. Whether the statement is true or false is the answer I'm kind of expecting from you guys. I'll wait for like a minute and then kind of then move on. Okay, so most of the answers that I got is correct. So basically, the statement is true. As I already said, coupon stays constant unless otherwise stated while investing. Yield or the price keeps changing basis the quality of the security or the market scenario that particular security brings. So we'll the same concept we'll try and understand and break down in detail in upcoming slides. So, as earlier mentioned, this particular presentation will cover only the assessment part. So, what are the parameters that one should consider while assessing a fixed income security? First and foremost is the the credit risk or credit quality. Second, the liquidity aspect. Finally, the market condition, and then interest rate variables that affect fixed income asset class. uh, in my last presentation also, I'll keep referring to my last presentation because there are few things that I want to kind of continue in this particular presentation also. So as I had mentioned earlier, when one invests in fixed income or debt as an instrument, one there's only one sort of risk that stays throughout the investment, and that's the beauty of this particular asset class, right? If you buy a particular fixed income security and stay invested till the maturity of that particular instrument, the only risk that one has to worry about or the client has to worry about is the credit risk. There is no other risk that comes into play, come what may, whatever happens throughout the market scenario in the economy or otherwise. The only risk that stays constant is credit risk, and there's no other risk that comes in. We have to understand fixed income as an asset class or a security is basically a promise, right? It's a promise to sort of pay the money back that has been taken along with the interest that is promised at the start of the issue. So basically, it's a promise, it's a contract, and obviously, that holds high regard, in terms of when in the investment environment, basically. So what do we mean by credit risk? So credit risk is nothing but one's ability to pay back, right? So there are multiple ways one can sort of assess how to kind of understand the credit risk. One major parameter is obviously the credit ratings that are sort of that a particular instrument carries, ranging from AAA, AA, A, and so on. There are two different types of ratings that are there. One is a short-term rating, one is a long-term rating. Short-term ratings are basically, ratings for 1 year and below. Long-term ratings are for businesses or securities which, the tenure is beyond 1 year. So as I said, credit risk is nothing but ability to pay back, right? So while one is assessing, obviously there are a few parameters one need to sort of take into consideration. Obviously, first and foremost, what sort of a credit rating that particular instrument has, what sort of a risk profile you as an investor or investor in general, is comfortable taking, and depending on that and what sort of return one is expecting. So you will find different types of ratings will give you different types of returns, and one has to match your own risk profile with the returns one is expecting. And as the law states, right, higher risk higher returns, similar goes with fixed income instrument also. Higher the credit rating, the lower the yield you will get. Lower the credit rating, higher the yield one will get. So few things that really help you kind of assess the security beyond the rating is, you need to look at the you have to first and foremost have visibility of your investment, and does that visibility of your investment match the tenure of that particular instrument. So for example, if you want to invest your money for a year, you have to then sort of assess a paper depending on what sort of visibility that particular business has in the course of 1 year. Within a year, do you think that particular business will encounter a lot of issues, or are there any major external factors that may come in within that year that could hamper the business and subsequently the ability of the issuer to pay back, right? So visibility is something that you need to kind of sort of decide before assessing the particular instrument, so that it gets easier for you to look beyond credit rating. So for example, if a rating of if an instrument which is rated A or double A, you then have to kind of assess if that particular business will stay and stay strong for the tenure of investment, and then maybe take a call. Then one thing that helps is the parentage of that particular businesses. There are a lot of businesses, you have to understand who's the ultimate beneficiary owner of that particular business, and what sort of track record that particular business has. For example, obviously this is not a investment advice. Just for example, Tata as a parent company has a lot of subsidies. So a subsidy of Tata, even if not rated high, you somewhere will get a comfort ki, there is a strong parent behind this particular subsidy, so you can maybe look beyond the rating and take a call accordingly, right? And few basic things, as the quality of business. You need to understand what sort of business these particular issuers are into. Most of the securities that are available in the market are from NBFCs or a lot of financial entities. So you need to also understand these financial entities. Post you give them money, where do they finally take that money and lend? What sort of credit risk those that sort of borrowing profile that they lend to, and things like that, right? So this is about the credit risk that you have to make. One, obviously, you have to look at the rating. Second, you have to sort of compare or have the tenure in mind for your investment. And when you have to look beyond, credit rating, what are the aspects that one need to sort of look into? So just again, just to make sure that everyone, I know we are at 4:20. Just to make sure everyone's in this call, there's another quick second question I have for you guys. I sort of gave the answer away already, while kind of giving you a brief about credit risk. The question simple: what is considered as highest, long-term credit rating? The options are A1, AA plus, and final answer is AAA. So I'll wait for like maybe a minute. Okay, so most of the answers are AAA, and that is the right answer. So as I said, there are two types of ratings. One is a long-term rating, and one is a short-term rating. Short-term rating, the highest is A1, and then subsequently goes down to A1, A2, A3, A4, respectively. Whereas long-term rating starts from AAA, and then subsequently goes down to AA plus, AA minus, A plus, AA minus, etc., etc. Then goes on to B and all. So there are two types of ratings. If you are investing For over a year, you have to look for long term rating. If you are investing for less than a year, you have to look into short term ratings of the instrument. Moving on to the liquidity risk. Now, as I said, right, if you invest in fixed income instrument and stay put till the maturity of the instrument, you would not face any sort of risk throughout your investment apart from the credit risk. But for whatever reason, see, at the end of the day, it's, you one invest in money to be able to use when required most, or even to sort of take advantage of market since it's an open market, right? So if you have to kind of trade in secondary market of fixed income, there are few two three risks that get attached to your investment. First and foremost is liquidity risk. Now, why liquidity risk? Liquidity risk is nothing but how quickly can you buy or sell, or how many participants are there in the market for a particular security. Now, with the way this asset class works, right, it comes with the unique characteristics in comparison to equity, right? For example, company ABC, right, will have, if listed in equity market, will have a single share that is being traded. So if you want to buy company ABC in equity, there will be multiple buyers and sellers in the same sort of one particular security. But when it comes to fixed income, right, same entity might have as high as 100 or 1,000 sort of different securities or signs, because company may keep raising money for different tenures, different requirement, different investment, sorry, interest rate scenario keeps changing, company keeps changing their plans, and they'll keep coming up with going to the market to raise money time and again, right? So there are companies which will raise money every month. So basically, a company ABC might have different security coming up every month. So having a buyer and seller, or having enough liquidity in that particular holding that one will buy, may pose a challenge when it comes to sort of liquidating your assets. So liquidity is the one of the biggest challenges that fixed income security that in this particular asset class one may kind of come across. One thing that is constantly changing over the period in the context of Indian industry is when initially, at least 3 4 years before, most of the fixed income securities had a face value of 10 lakh, meaning if you wanted to buy a fixed income security, minimum investment required was 10 lakhs. Now slowly that sort of is changing. And just to give you a simplistic understanding, if if buying and selling is going to happen in multiple of 10 lakhs, inherently lot of retail participation just goes off. So it's only the market of HNIs, ultra HNIs, or basically institutions that will come into play. Now what has happened is that to increase liquidity, there are few things that a regulator is already doing. First, this year only, regulator has come out in the market and said all corporate bonds issuance going forward should have a face value of 10,000 rupees. So instead of having a bond minimum investment of 10 lakh rupees, now client may start investing from as low as 10,000. Now, a lot of instruments that are coming up with a face value of even 1,000 rupees, meaning lot of participants will come subsequently, giving rise to number of participants in the market and increasing the liquidity of the instrument. One more thing that they're sort of doing is they have, uh, SEBI has come up and told all the institutional brokers to, start trading in RFQ platforms as a rule. RFQ platform is nothing but online trading platform wherein brokers have to, compulsorily start trading at 25% of their overall, book value in this particular market, so as to increase the liquidity for the overall asset class. Um, the way to sort of factor in, or deviate, or have certain sort of protection over liquidity is, one needs to choose quality papers. As stated earlier also, you have to always start from the point wherein you need to know your tenure, and stay put invested for that tenure. If you can't, you will always have to buy a quality instrument, because quality instrument meaning quality business will never go out of flavor in the market. There will always be buyers and sellers in the market available. Finally, you have to look at the free float available of that particular instrument. For example, if company ABC is raising only 100 crores, meaning there are only people, there'll be limited people, who will have this particular instrument. So higher the number of raise, then higher the number of clients, and subsequently higher the liquidity in the market. Now moving on to the market condition. Now there's a thin line between what constitutes as market condition and liquidity. More or less, it's to do with the participants in the market. Higher the participants, higher the liquidity. Similarly, in market condition, what I want to sort of tell you is, see, at the end of the day, when we are in secondary market dealing with market participants, when you are buying and selling between market participants, the one problem that even equity faces is the sentiment issue, right? Even if the business is great, even if the visibility for that business is great and everything, but if sentiments are not good, then it will subsequently impact the prices of that particular instrument. Come what may, where the market or in general the economy is going, it will not really sort of give you the best returns if the sentiments turn negative into your investment. So market risk comes into perspective while investing in fixed income too. And again, the demand supply gets sort of hampered if if sentiments are wherever the sentiments are, if there are particular institution or clients who don't want to sell, come what may, then again the prices may go up because the float is less. Similarly, subsequently, if people when if people want to buy and your institutions or uh, whoever is holding the bonds don't want to sell, you might not end up getting fair price for your investments. So market conditions sort of come into play, when you have this as asset class. As I said, there's a thin line between liquidity and market conditions, but just the sentiment aspect of it is what separates both of them. And then finally, moving on to the major variable that sort of defines fixed income instruments or gives a way forward on how the your returns would be looking in coming years, or what sort of a core or strategy one should be taking. All of that depends on the interest rate scenario of an economy. So before getting into the details of how interest rate sort of affects your fixed income instrument, I'll take you back to few things that we'll need to understand before we deep dive into this subject. Uh, we have to understand, basically, we'll have to understand rate transmission. Rate transmission is nothing but you have to, in equities, there is a benchmark, right? Sensex, generally Sensex or Nifty 50 is a benchmark for your own personal portfolio or mutual fund investment. You'll always compare your sort of portfolio with these sort of benchmarks, right? Similarly to that, there is sort of benchmark building or sort of view that one will get while investing in fixed income securities. And what I mean by rate transmission is the benchmark here generally, or what gives a way forward is the interest rate scenario that is being given by RBI. What it basically means is what is the yield or return one is getting if they invest on the safest sort of instrument, right? For example, if you are investing in GSEC yeah, is nothing but government securities. In today's time, GSEC is considered as the most safest instrument to be invested in today's time. So if GSEC is giving you a particular sort of return, and a PSU or a PSU which is obviously owned by government has to come up and sort of raise money from the market, PSU will have to sort of give certain sort of higher return over GSEC for investors to make sense and invest in PSUs. If PSUs are giving similar to returns similar to the GSECs, It doesn't make sense for any investor to sort of take risk and invest in corporate, wherein you can easily invest with government, right? So after PSUs comes our AAA corporates, for example, Tata, Reliance, etc., etc., Axis, HDFC, right? If they want to raise money, they'll have to give a yield which is, over and above what PSUs or government is giving. Similarly, a AA instrument who's rated AA will have to give a yield higher than a AAA instrument, and subsequently the rate transmission keeps happening. So, as I said, the benchmark is set by RBI in form of, the interest rate scenario that they build. Now, we have to understand how does RBI or central bank take this call, or give a view on, or give a way forward on the interest rate scenario. So we have to understand RBI or central banks across economies. One of their major tasks in hand is to balance, have a right balance between growth and inflation, right? If a bank is promoting growth, it will also lead to higher inflation, right? And higher inflation obviously is good for, growth is good for economy, but higher inflation is not good for a lot of on ground citizens, or market as a whole, right? It can again turn into a negative loop. So the major understanding or a macro understanding that economy has is, uh, just to take an example, if the assumption when RBI increases rate is, if the rates are high, meaning banks will also have to lend at a higher cost, meaning a lot of businesses, if they want to expand their businesses today, might halt their plans, because funds are very available at a very high rate, meaning their output on that particular business might not break even in the time frame that they want. Subsequently, meaning if the business is not expanding, meaning there are not more jobs created, or growth created for the employees. If there is no growth created for the employees or jobs for the employees, meaning uh, for citizens of the country, there will be less money in the hands of the citizens of the country, meaning they'll spend less, meaning the demand will go down. Subsequently, because supply will be high, the prices will go down and inflation will come down. That is the general macro understanding. Similarly, the reverse case is, if interest rate scenarios is low, the funds will be available at cheap, businesses will be able to, or wanting to borrow more, creating more jobs, more money in hand of the citizens, and they'll spend more, meaning demand will go up, and subsequently inflation will also go up. So there is always a balance that central government has to maintain between growth and inflation. Right now, let's take an example of India. Now, RBI's comfort zone on where the inflation number should be is 4%. So, RBI wants India's inflation to be at the number of 4% plus minus 2. So, the range is on the lower side of 2 to 6. So, if inflation is between 2 to 6, RBI will always try and push growth, right? But if the inflation goes beyond 6, or even anything beyond 4, RBI will keep an eye on inflation and try and control that inflation. So if we sort of see where we are today, our inflation has been hovering around 4.5 to 5% for a very long time. It has not gone down. There are multiple parameters that keep kind of affecting the inflation. One obviously is food inflation. So now RBI wants that inflation to come around 4, and then sort of think. And on the subsequent side, if you see growth, India's growth is not getting hampered because of whatever is happening in the economy. So RBI doesn't feel the need to reduce the rates as of now, because growth is already on its trajectory. They've already come out in last MPC meet and revised India's growth numbers from 7 to 7.2. So growth is already coming up. So RBI is not feeling the need of reducing the rates. Plus, inflation is being very sticky at this 4.5 to 5% range. So if consistently that inflation comes around 4 or below 4, is when RBI might then again start reducing rate and start giving push to the economy. Um, how does this entire thing link up to your investment? So what we have to understand is, if we are in a climbing interest rate scenario, the best thing for a fixed income investor is to sort of keep locking your higher yields from quality companies, because interest rate scenario will be high. Companies will be willing to borrow money at higher cost, meaning your returns will be sort of on a higher side. So basically, one needs to just sort of lock in your yields from quality paper on the higher yield, so you keep taking advantage of higher interest rate scenario. On a reverse scenario, when interest rates are going down, uh, the best thing is to sort of buy these securities at a higher yield and then sell it at a lower yield, because the yields and prices are inversely proportional. If the yields are higher, prices are low, and if the prices are high, meaning yields are low, so you tend to benefit from that. So moving on to the final question of the session. So yeah, the question is pretty much simple. What is one of the major tasks in hand for central banks like RBI? Balance between inflation and growth, control inflation, boost growth. Yeah, most of the answers are correct. RBI has to maintain the balance between growth and inflation. So, as a fixed income investor, one has to always look at where the inflation number is. The target zone for RBI, as I said, is 4% plus minus 2. We have to keep an eye on where that particular number is. And subsequently, you have to look at the GDP growth numbers of economy. Are they on the rising side and all? So if one will get a basic idea on what RBI would do on their call of interest rate, and then subsequently you can take a call and make most out of this particular asset class. Uh, so what I'll do is I'll end my session here. As I said, in upcoming sessions, we'll try and understand the basic calculation concepts on uh, and how to align your investment goals with fixed income securities, and finally we'll get an in-depth knowledge on where this particular or how the fixed income market in India looks like, and how we can benefit out of that. So thank you guys. Thank you from my end. If there are any questions, I'll be more than happy to sort of answer them.
So we have got one question. Are there any ratings for debt funds?
So there are ratings for debt funds, but the thing is, not all funds get rated themselves. So one thing about rating is that particular institution or that particular mutual fund has to get their ratings done by themselves. So a lot of fund houses do it, a lot of fund houses don't do it. But now, majority I've seen the trend is a lot of these. Funds have sort of started coming up with their own rating. The rating uh, nomenclature is also very different. It starts as I said, in fixed income, triple A is sort of a long term rating and A1 is a short term rating. Similarly, there is a different sort of nomenclature for debt funds, and most of them sort of have started doing that, but it is not a compulsory or a regulatory requirement. One good thing to sort of assess would also be, whichever debt fund you want to sort of invest in, uh, as a mandate, all debt funds have to come up with or disclose their portfolio holdings and subsequent ratings. So in that particular holding statement, you just see what sort of securities they've invested in and their particular ratings in front of them, and you can get a fair idea on what sort of rating profile that particular portfolio carries.
Thank you, Sachin, and I hope Narasimha, hope your doubt is cleared. So we'll conclude today's session. As we conclude, let's apply this newfound understanding to make informed financial decisions. To all attendees, thank you for joining us. Let's continue continue this journey together. Stay informed, stay inspired, and stay empowered. Keep an eye out for our next informative webinar. Until then, stay connected with us for more updates. Thank you once again for being part of Yes Pulse.